In order to understand what options are, let's start with an example. Meet Zoe. Zoe has a car. This is Bill. Bill requests from Zoe to give him the right to buy the car from her at $15,000 in cash anytime during the next month. Zoe might agree on the condition that Bill pays her 2% of the value of the car, which is $300, for waiting out the month without a transaction. Zoe cannot sell her car to anyone else during this waiting period. Bill does not have to buy the car in this time frame, but he does have the right to do so. Let's look at the definition. An option is a contract allowing the recipient the right, but not the obligation to transact a known transaction, buy or sell, of a known asset at a known price in a known predefined time frame. A contract, the option agreement between two parties. A recipient of the option right. In our case, it's Bill, also called option buyer or the option holder. A known asset, the core of the option. In our case, it's Bill's opportunity to buy a car from Zoe. At a known price, $15,000, also called strike, and $300, which is the price of the option. In a known predefined time frame. In our case, 1 month. After that time, the option has no value. This predefined time frame in which the option will be exercisable is called the option's term or duration. Options that can be made exercisable at any time during the time period are called American options. Options that can be exercised only at the end of the period are called European. The person giving the right and taking upon himself the obligation, in our case Zoe, is sometimes called the originator or option writer or option seller. The technical name of an option that involves the right to buy an asset at a price is a call option. In our case, Zoe sold a call option to Bill. Options are very useful tools in business and are indeed used to help execute all sorts of transactions and help reach all sorts of business goals. Here are a few examples. A. Sarah is a real estate entrepreneur. She meets Philip, the owner of some land close to the beach, who wants to sell his property. Sarah knows of some friends who would love to buy luxury apartments in this location, which is a high-demand zone and characterized by limited supply. Sarah approaches Philip and proposes a deal. The owner will award Sarah with the right, but not the obligation, to buy the land for $3 million anytime within a 24-month period. Within this time, Philip's property is off the market, and Sarah will have time to proceed. Sarah has high conviction in the project and pays Philip $50,000 for the option on the land. Sarah then prepares the plans and finds out she can build 30 condominiums. She approaches 10 friends and offers them to buy a condominium from her at $750,000. 8 agree to the transaction and are willing to commit half the proceeds up front to secure the property. Sarah has sufficient capital to secure the deal and now exercises the option to buy the land. In this case, Philip sold a call option to Sarah. B. Margaret owns a coffee shop chain. One day, a competitor approaches her with a proposal to purchase 50% of her business. Margaret is happy to accept the cash offer and negotiates a $2 million company valuation. For some reason, the buyer doesn't want to buy the whole company, and Margaret worries that differences in business approaches and management styles might pose a problem. Jeff, Margaret's friend, comes up with an idea. The buyer will purchase half the business for $1 million, but will also grant Margaret the right, but not the obligation, to sell her full remaining stake in the business for $1 million. Based on the existing valuation, times 50% remaining stake for a term of 5 years. If Margaret executes the option, the buyer must comply. The buyer awards Margaret the option, and the deal is executed. The competitor buys 50% from Moonbuck's coffee shop. Margaret is $1 million richer. The new partner demands to improve profitability and takes drastic measures such as firing 2 critical high-cost employees. Profits promptly plummet, resulting in an operational loss. Margaret is devastated, but Jeff reminds her of her option to sell the remaining stake in the company, so Margaret promptly exercises the option to sell. The partner finds to his dismay he can't back out from the deal and must shell out an additional $1 million to buy a now worthless loss-generating business. Margaret had the option to sell her share at a price they agreed to before. This option's technical name is a put option. Think of the option recipient, Margaret in our case, putting the now worthless remaining shares in her partner's hands and taking the money from his pocket. Now Margaret can take her dream vacation and sip margaritas with Jeff.